Tonight we talk about income tax issues in real estate as well as some advanced commercial concepts. We're on page 74 in the gap part of the program. You do need to know the definition of a capital asset. Okay, we're going to look at capital asset right now. Property which cannot be easily converted into cash, which is usually held for long periods. We include business equipment as well as real estate in this category. Okay, next, we look at the term appreciation. Appreciation is the increase in value of an asset over time. Of course, that's one of the main reasons that we purchase real estate. That's why I decided to sell real estate instead of sell shoes. When property is sold at a gain, some element of that gain is attributable to depreciation deductions taken in prior years. Under current law, commercial property has a depreciable life of 39 years. If you own residential property, that means property that people can live in, or you own commercial property where work is done, whether it's a warehouse, office space. Those are the most popular types of property that you'll see in the field as you're practicing real estate. Take a look at the box over to the right. There's a box on page 75. Those two numbers you need to memorize. 27.5 years is the number we use for depreciating residential real estate. So if you have a mobile home park, if you have an apartment complex, if you have anything you can live in, a hotel, you know, it's where people sleep there, people can live there. That's considered residential. Manufacturing space, anything like that, that would be depreciated over 39 years. So let's look at the example that's on that page before I continue with terms. There's usually 1 to 2 questions on the state exam that covers these concepts. The one most important thing you really want to know out of here is memorize 27.5 for residential and 39 years as far as depreciation goes for commercial. And what I want to explain about this is that you get a tax deduction for owning investment property. You can't use this on residential property you live in. So remember I said to get your calculator out, right? Suppose you have a rental property, and we'll use a real straightforward number. Let's say you have a 2-family home that you don't live in. So you have a 2-family home that you don't live in. You purchased it for $150,000, okay? What you do on your calculator is you divide $150,000 divided by 27.5, $5,454 from the income producing part of that real estate. Write that number down for a moment, okay? 5,454. That's important. This is your tax shelter that you get every year for owning this property. So since it's residential, we divide it by 27.5. And if it's commercial, we would do it by 39. 600 times 2 is $1,200 a month. So you're collecting $1,200 a month. We multiply the rental of $1,200 a month by 12 months because that's how many months we have in a year. Do that on your calculator. 1,200 times 12, and that's $14,400. Gross income of this property from the rent that you're collecting is $14,400. What we do is in order for you to do your income tax and calculate how much tax you pay as far as to the government, you know, to the state and federal government, we have to figure out what's your net operating income. So all the expenses that it takes to run this property, you have to take into consideration. We're only talking about recapture right now, okay? We're just talking about recapture. So the income after you take your allowed depreciation expense is $8,946. That's $8,946. That's a huge savings. Like, that is incredible. You don't get that with every type of thing that you invest in the world. That's one of the reasons why real estate is such a great investment. So $8,946 is what you're taxed on, instead of the $14,400. Now, you've got other expenses too. If you pay the water bill, you subtract that. If you had maybe pesticides applied at the property, you had to hire an exterminator, then you would include that as well. You know, landscaping for the property. Anything that you pay to make that property operate, you subtract. If you had to advertise to find a tenant that's there, you can subtract the advertising costs. Okay? Now, I don't want to get into a whole big, huge income tax course out of this. But long story short, when you purchase a property, you take the purchase price, you divide it by 27.5 if it's residential, or 39 years if it's commercial. And the number that results is the amount that you can deduct every year from whatever that income of that property is. So let's say you own this property for 5 years, and then you get this job opportunity out of state, and you're ready, and you want to sell the property. Let's say you don't want to be an absentee landlord, okay? Then what you do is you take all the years that you lived there, all the years that you own that property, 5 years, and you have to do this thing called recapture, but you have to pay the piper later on. And the way you pay the piper is you're going to be paying tax on what you would have paid tax on, and I'm going to show you the math for that right now. So if you take the deduction that we told you earlier of $5,454, so put in your calculator, $5,454, you multiply that by 5 because it's 5 years that you took that deduction. Your total recapture will be $27,270. So $27,270 is your total recapture. Okay. In 5 years, that $150,000 property that you sold has appreciated to $189,000. So we're going to pretend you sold this property 5 years later for $189,000. You should write that down on a piece of paper. $189,000. We're going to make it just an even $189,000. First of all, you need to calculate your capital gain. Now, the nice thing about this, it all makes sense. There's nothing shocking. There's no special algorithms that you need to know. It's not difficult math. It's adding, subtracting, multiplying, and maybe dividing. That's all we're using, which they do that in elementary school nowadays. So $189,000 is what you sold it for, but you paid $150,000. So you subtract $150,000, your original purchase price for the property. Put that in your calculator. 189,000 minus 150,000. So your capital gain on that property is $39,000. But anyways, so $39,000 is your appreciation. So 5 years of recapture was $27,270. We add that $27,270, and again, $27,270 comes from $5,454 times 5 years. That's where you get the $27,270. So $39,000 plus $27,270 gives you $66,270. Oh, since it's over 12 months, there's long-term capital gains. And that long-term rate is usually more favorable than what the standard rate is. That's why it's important for you to understand that if you get an exam question that asks you about, is it long-term or short-term capital gains, you always want it to be long-term. And of course, you always want to verify this information if it's your own property with an actual accountant, because the laws can change and you want to make sure you're doing everything proper. But we're covering what the state wants you to know for test purposes. One thing you can do is if you have a big capital gain that's going to happen, there's a thing that you want to know for test purposes called a Section 1031 exchange. A Section 1031 exchange is where if you invest that money into another piece of property, then you can keep deferring your capital gains indefinitely. We haven't covered that yet, but you'll see as we get to it. A 1031 exchange allows you to defer paying capital gains as long as you stay invested in real estate. And the trigger word for a 1031 exchange is the phrase like kind. I'm saying L-I-K-E, like kind exchange. So I've seen people do tax-free exchanges from residential real estate to a yacht that you can live on. Long as it's, people do live on boats in some parts of the country, whether it's California, Florida, or elsewhere. So if that's the case, you're still able to defer using a 1031 exchange. So just remember, when you sell the property, if you depreciated it, you have to always remember to do the recapture. And this is only for non-residential property. In other words, you can't do it for your primary residence. You cannot do what we're showing you for the home you live in. This is strictly for investment real estate, whether it's investment residential property or investment commercial property. So it's like kind, L-I-K-E-K-I-N-D, like kind. All right, now, I think that's about all I have to tell you as far as recapture is concerned. And sometimes it's really confusing to people. The biggest things you should have had as far as a takeaway right now is the fact that it's 27 and a half years is your depreciation schedule for residential property, 39 years for non-residential property. On the state exam, you're not going to have more than 2 or 3 questions that come from this section. That's at the very most. And for the most part, it's going to be those 27 and a half and 39 is what you're going to see most of the time. Gross income, total income from real property before any expenses are deducted. So in the example for that $150,000 property that we had $600 in rent for each unit. So it's $1,200 a month. $1,200 a month multiplied by 12 months. Everything, when we're doing numbers, everything's based on annual figures. Now, when you see debt service, please remember, debt service is the mortgage payments that you're making on the property. Please know for test purposes, the mortgage payment is never considered an expense. I want to step back a moment and just talk a little bit about when I was giving you the list of expenses for this property. Do you remember I mentioned that the property taxes you can deduct from the income of this property? Landscaping might be an item that you also have. You might pay the water bill at the property. These are all expenses that you want to reduce from the gross income of that property. You don't want to pay tax on money that you have to pay out to run the property. Income tax doesn't work like that. Thank God it doesn't, or people would want to be involved in investment real estate. Okay? So sometimes people are tempted to want to, let's say, take that mortgage payment and deduct that as an expense. So you can't do it. You really got to remember this. You cannot deduct mortgage payments as an expense on the property. Please know that for test purposes. Another name for mortgage payments is debt service. Next, we look at the term tax shelter. It's typically defined as any method used to reduce taxable income, thereby reducing the amount of tax. Then we have the term depreciation, which we've been talking about. And then in the middle box, I'm going to let you go through that on your own since I gave you an example in real time. Read the box on your own. Follow the methodology that's provided and see how that compares to what we did. I think it'll be helpful for you. Then we see the term depreciable basis. Most of the time, the amount depreciated is simply the amount the investor paid for the asset. So for personal investments, they cannot generally be depreciated for tax benefits. In other words, what that means is that the house you live in, you can't depreciate. The second home that you own, if it's your second home, you can't depreciate that either. But there's specific rules, because if you rent out your second home too much, then it's not considered a second home, it's considered investment property. And we cover that in on page 76. So let's look at the third paragraph. If a taxpayer had previously sold his or her property and utilized a tax deduction, he or she would not qualify for the exclusion unless a current sale is at least 2 years after the taxpayer benefited from the previous exclusion. So again, they're making it so that's really meant for the typical buyer out in the marketplace that's moving into a property, and they're not doing it for investment purposes. At least not active investors. The bottom of 76, understanding passive income. All rental activities are subject to certain exceptions. The taxpayer must be a real estate professional by spending at least 750 hours of service per year in real estate. So you're considered, the minute you get a real estate license, you're considered a real estate professional. But the law doesn't say that you need a license to be considered a real estate professional. But it guarantees that you're a real estate professional if you have a state-issued license that's real estate related. Hope that makes sense for you. Let's look at the second last paragraph of page 76. In general, passive losses from rental property or limited partnership activities can only be used as an offset to passive income. Any unused passive losses are carried forward to offset against future passive income. Okay. Then we look at low-income housing tax incentives. Very, very rarely will you see test questions on that. So I just never ever you don't have to know these numbers. Next paragraph, the IRS requires 10% of each state's annual allocation of tax credit to be set aside for projects partially owned by nonprofit organizations. Again, you're not tested on this. So you want page 80 in the gap portion, only 4 pages to cover here. Okay. Loft lease. You want to know the definition of a loft lease. A lease for the rental of floor space that is not generally divided up into rooms or sections. That's what you need to know. If you're doing a flashcard, you put that on one side, and then you do loft lease on the other side. Next, we look at a loss factor. So hallways, elevators, circulation areas. In other words, you can't rent those spots out. It's common areas. That might even be an easier way to remember it. Think about common areas. A property owner sets their loss factor according to what the market will bear. And this just gives you a little bit more background information, okay? Look at CAM and know that CAM stands for Common Area Maintenance. Please know that for test purposes. CAM stands for Common Area Maintenance. Charges to tenants for expenses to maintain restrooms, hallways, elevators, utility closets, lobbies, etc. Okay? So this would be something that you'd be, if you rent commercial property, you would know what your CAM charges are. Because you have to take care of these, you have to take care of the common areas, the circulation areas and things like that. Do CAM charges change? Oh, they absolutely do change. Yes, they do. But it also, in the lease, in your commercial lease, it will identify what's the percentage charge. If it's a good lease, it'll identify the most it'll go up per year. All right, let's continue here. Let's look at pro forma statement. This has shown up. Actually, I haven't taken as many broker exams as salesperson exams just to keep current. I've only taken 2. I hate to tell you in how many years, but this was on one of the ones that I took, a pro forma statement. An operating statement, and here, again, it's the first sentence is what you need to know. An operating statement adjusted to reflect a potential change in income and expenses based on the investor's knowledge of the real estate market. And the property owner gives you all the numbers. Equity dividend rate is defined. Just give that a quick read through. Page 81. Non-disturbance clause. When you read that, you'll see that's just common sense, makes sense. Give it a cursory review. But I want to look at the premises clause in the second paragraph. Again, we're on page 81. Premises clause. It's located near the beginning of the lease. That is important to know. So premises clause is located at the beginning of the lease. It identifies the space a tenant will be occupying specifically. So we have strip mall at the bottom. Neighborhood centers are the next largest. And then we have an outlet center, which is 100 to 300,000 square feet. And is typically anchored by one or two large discount department stores. Okay, turn the page. From lowest to highest. If you have a multiple choice question on the state exam, you should be able to know in general what's the largest and what's the smallest. Usually they don't ask much about what's in between. Second paragraph, page 82, we talk about lifestyle centers. And we define that in that paragraph there. But I want to make sure we take a look at the bold item in the middle of that paragraph. A lifestyle center has open air plazas, sidewalks, street side parking, taking up a lot less space than a typical mall. Industrial properties, all things held equal, industrial properties are always worth more dollar per square foot than any other type of property. But you always have to check if, when you list a property that's in an area where it's surrounded by commercial property, a couple issues that come up when you've got a single family property, zone property. Actually, I don't even want to say single family zone. It's a single family property. It's probably not even zoned as single family. It's probably zoned as some kind of commercial or something denser. Denser means there's more you can do with it, a lot more that you can do with it, like industrial. And it might have changed over the years. So the person stayed there, didn't sell, and the neighborhood changed around him or her. So in the example that I'm giving you, he had no interest in selling the property when he probably could have. It was next to a waste management company. Forget the name of it. They're the blue ones that have the red print. You can't get a commercial, if you have a commercially zoned property or the density of commercial property around a residential property is too great, you can't get a regular Fannie Mae or Freddie Mac mortgage. You're going to have a hard time getting a loan. Like, you just can't go to M&T Bank and get a loan. Like, they care about that. Banks don't like to lend cheap residential money in an area that's changing to commercial. If there's a heavy commercial use, that raises significant risks to the lender. So you're going to run into financing problems, and it might only be able to sell a property with a cash buyer, or the buyer will ask you to put in the contract a request to have the zoning changed as a contingency in that purchase. So anytime you run into a scenario like this, you have to run it by, and I know this as a commercial appraiser, and when I do appraisal work for banks, this is one of the questions that I have to answer in the appraisal. When I take a picture of the street scene and I go down both ways and show them the activity in the area, they're going to say, well, wait a minute, you have to tell us what's a percentage of commercial use in the area and how much foreclosure activity is going on. Okay. So at the bottom half of 82, we talk about manufacturing and industrial properties. And just give that a cursory review. You should know that industrial properties consist of warehouses, manufacturing facilities, research and development centers, distribution centers, and generally contain large loft areas with few walls where manufacturing can take place. It's a lot. There's a lot more here that we provide you as far as an explanation, but you're really not tested on all of that. Again, bottom of 82, we talk about empire zones. Usually one of the biggest controversies right now with empire zones is the government that you are going to hire as far as goals for each year. Have you attained that or not? And that's like one of the biggest controversies right now is no, usually the people who got all the benefits from the empire zone, which is usually some version of tax abatements, like not having to pay property tax, not having to pay sales tax on certain purchases. Okay, well, we're going to waive all of that as long as you hire 100 people a year. Well, then they look at the results after a few years and they see that they only hired 100 over all 3 years. Well, the controversy is, do we take back what we gave them or not? And that's like a long topic that we're not going to get into tonight. Page 83, so just 2 pages left. Applications approved by local zone officials are then forwarded to the state for review and approved by the Department of Economic Development, or the Empire State Development people. Give that a read through. We talk about wage, tax credits. These are some of the benefits that you get if you're in a Empire zone. Investment tax credits, employment incentive credits, zone capital credits, New York State sales tax refund credits. Just give it a cursory review. Very rarely are they going to ask you about the minutia of each of these items. Then we have enhanced benefits for qualified Empire Zone enterprises. Again, give that a cursory review. Don't knock yourself out. There's lots that you already need to know, but hopefully you do know that these are the benefits you get if you have your business in a an Empire Zone. These are some of the benefits that you get. You have a good evening. Thank you for participating, and